Hey, it's Soleil, and this is episode 124 of the Orange Pill Investor. And today I'm going to talk about credit spreads and why I still prefer selling covered calls and cash secured puts to credit spreads. But I will go over them and and there's reasons why you would necessarily have to use them. But I'll go over all that, but I'm going to throw something in there that I kind of developed on my own. If you are a spreadsheet nerd or a degenerate gambler, there's such a thing called the Kelly criterion, and depending on whatever house advantage there is, or your advantage, there's a formula for how much you should bet of your total, your stack, basically, your portfolio. And if you keep that size down, you should never go broke, even on like wide swings. You know, like you can, if you're playing blackjack, you can win 10 times in a row, or you could lose 10 times in a row. But if you trade at this particular size, Kelly criterion says you should never go broke. So it basically just sizes your positions for you. So the Kelly criterion is absolutely not something that I came up with. And the idea to even figure it out came from Tasty Trade videos. I've watched hundreds, maybe 1,000 hours of Tasty Trade videos. And unfortunately, I've bookmarked a metric ass ton of them, and a lot of them are just gone. And so I'm kicking myself now because I wish I would have downloaded some of these things. Some of the research that they've done is just out of this world. But I took some screenshots from a video way back in the day, and there's this complicated ass formula, but you can go and study it if you would like to. But the bottom line is, if you take the percent chance that it's a winning trade, and as far as credit spreads are concerned, it actually works out very well, because if you have a $5 wide, well, let's just make the math easy, a $10 wide credit spread, that's going to be $1,000 that you are basically wagering. And if there's a 50% chance that your credit spread will win, then you need to collect more than 50% of the collateral in order to make it advantageous. So if your collateral is $1,000 because it's $10 wide, the strikes are $10 wide, and there's a 50% chance that you'll win the trade, if you collect $750 in premium, then your max profit is $750, your max loss is $250, and that's a hell of a trade. You would take that every time. So I put it into a little spreadsheet, and I put it in here, and I got all the little the formulas in here. And so what I did is I decided to have a little fun. I haven't traded spreads in quite a while. But I said, okay, I believe in MicroStrategy. So over the next couple of years during this Bitcoin bull run, if it does continue, on average, I will assume that Bitcoin in the future will be worth more than Bitcoin in the past. Obviously, from day to day, that can have wild swings, but that's why we go out 45 days to expiration. I've already done videos on that. That's when theta really starts to accelerate. So for credit sellers, option sellers, 45 days to expiration is anything under that is when theta really starts to accelerate, theta decay. So that's good for you. You want to sell it, and then you want the value to decay out of it, and then you want to be able to buy it back later for cheaper and split and keep the difference. So since I think that MicroStrategy will be going up mostly, I am selling a put credit spread. So just like selling a put is bullish because you think the price of the stock will go up, so does a put credit spread think that the price of the stock will go up, or that it will at least remain above the strike price. I'll do the same thing in Robinhood so we can see the different UIs. But the point is, and these are just bid and ask, so really I split the difference and got the mark prices. I need to get that into my columns if I can find that. But let's just say you sell this option for 8,300, 83 bucks, and you buy this one. You always, if it's a credit spread, you have to sell the more expensive one and buy the cheaper one. And so the inside strike, the one that's closer to the share price, is going to be more expensive, and the one that's farther out, the outside wing, is going to be a little bit cheaper. So you sell the 83, you buy the 79, that's about a $4 difference. So you're going to be paid 400 bucks. Since it's the distance between 1100 and 1090 is $10, the collateral that you have to put up for this trade is 1,000 bucks. So your max profit would be 400. So eventually, if you kept this all the way to expiration, or for however long it took, and the value of this option goes to 0, then you can buy it back for like $1, and you'd keep the whole 400 basically. Max loss, though, and this is why I don't like credit spreads, max loss is everything you didn't get paid up to the collateral amount. So this is a $1,000 spread. You got paid 400. 1,000 minus 400 is 600. So your max loss here is 600. Because if you lose the whole 1,000, you still got paid 400 up front. And the reason why you would do this out of necessity is if you just have a small account. If you've got, some of these stocks can be traded 50 cents apart. So the whole credit spread would cost you 50 bucks total. So if you have like a $500 account and you're like, you know what, I can't even afford 100 shares of HUT because what I would do if I had a small account, I'd probably just get, if I had a couple grand, I'd get however much, maybe 100 shares of MARA or CLSK or whatever the hell, and then I would just start selling covered calls in it and buying additional shares of the cheapest stock I could find, maybe something like HUT. And then once I had 100 shares of HUT, then I would just sell a covered call in that too. And now I'm selling a covered call in MARA and HUT, and I would keep buying more shares of HUT. And I would keep doing that forever until I had thousands and thousands of shares. So, but if you don't have that, you're kind of just stuck with spreads. But here's the problem. If I buy, let's just look at the chart of MicroStrategy. So even if I bought at the top at 2 grand, right? I was like, holy crap, I'm feeling FOMO, and I'm going to buy at 2,000. And I'm going to buy 100 shares of MicroStrategy at $2,000 a share. I lay down 200 grand, and then I cry myself to sleep a couple weeks later because it's at 1,000, right? I've lost half of my value. I paid 200 grand. Now my portfolio is worth 100,000. That is not the end of the world because you have an asset. You own shares. And the way that I like to think of my shares is the price is X. I kind of don't care what the price is. So if I have 100 shares of something, I have X. And I can go out here and I can sell a covered call against X and get some percent of that. So if you own shares, you have a valuable asset and you can sell covered calls against it. Doesn't matter if you lost half your money, you can still find a strike out here that you can generate more income from. So as long as you don't pick, what was it, who was going in bankruptcy? Was it Hertz or some damn body years ago when they were about to go bankrupt? I mean, as long as you're not investing in something that goes bankrupt, and I have actually invested in a couple, but as long as you're not that dumb and you pick something that literally just doesn't suck worse than everything else on the planet, as long as it has some value, as long as it has, it's at least worth $10 a share, you should be able to. I mean, I've traded stuff that was like $3 a share, $2 a share, and still been able to go out to 45 days and get some premium off of it. So as long as the damn asset doesn't go to zero, it still has value, and someone will take the trade opposite you, as long as it's a liquid stock. So you're never, as long as your stock has value, you're never dead in the water. However, if the only amount of money you have is $1,000 and you place one of these credit spreads and the collateral is $1,000, if you get paid that $400 and this goes to zero, now your $1,000 went to $400, and you don't have any. You just have the $400. You don't have 100 shares of stock that you can just go back out to the market and sell something else in. Now you have to go and sell another credit spread, but you can only go up to $400 worth of collateral. So credit spreads can be good, and in general, the way that they're good is a tool that I mentioned previously. It's market chameleon. So this, if you go to the implied volatility rankings, here, options implied volatility rankings report, and you find, you click on a ticker, it'll open up another tab, and then you can just put whatever ticker you want in here, and it'll give you the implied volatility chart. So up here, when implied volatility is high, this is when you want to sell options. And then when implied volatility crashes, generally the value crashes, and that's when you want to buy it back for cheaper. So let me just go to MicroStrategy right now. And this is one reason why the premium for MicroStrategy was amazeballs. What the frick? That's not what I wanted. There we go. So when MicroStrategy just rocketed up, implied volatility went through the roof. It's like 160 up here. So it was 80, and then implied volatility doubled. Options prices were amazing here. So you were selling options, and then as the price dropped, you were able to buy them back cheaper and cheaper and cheaper. Now, unfortunately, that means that now that I want to sell covered calls against MicroStrategy, I'm not getting as much as I was just a month ago. Them's the breaks. So MicroStrategy is not the greatest stock to sell options against as it was. But if you were dead set on selling credit spreads, you can use Kelly criterion to decide for you what would be the reasonable amount of your portfolio to allocate to it. And so I got paid. I created a $10 wide spread, which is $1,000 in collateral. It's actually less because this is a margin account, but let's just assume that you're not trading on margin, and you actually had to put up the full value. So I got paid $400. Where is it? It's right here, right? So I sold the put for 89, and I bought the 1090 put for 85. So I got paid $400. If I put that into my spreadsheet, that means that the width of the spreads is worth $1,000. I got paid $4 times 100. And so the probability, here's the part that is kind of variable. So if you go out here and you look at the percent chance that this will be out of the money. So this is the percent chance that this strike will be a winner. And as you can see, as you get farther and farther and down, these option chains are upside down, but so farther down, meaning cheaper and cheaper, the percent chance that the price will be above that number, of course, gets higher. So the Tasty Trade is saying there's a 60% chance this strike is a winner, which means that there's a 40% chance that this strike is a loser. And if it goes beyond the put that I bought, that's maximum loss. So in here somewhere, I could like win some, lose some. Like maybe, who knows? Maybe I get to buy it back for $500 and I only lose $100 instead of $600. You know, something along those lines. So this means that the probability is 0.6. You can also estimate the delta, but I don't know what calculations. Delta is supposed to be an approximation for your probability as well, but there's a big ass difference between 71% chance of this being a winner and 60%. It's definitely going to throw off the calculations if I was to use 0.71 in there. But I'm going to use the percent chance and just assume that that's true. That means that the B is from this. Oh God, this is the most complicated video I've ever made. But B is this here. So it's going to be your profit divided by the width of the strikes minus your max loss. So that's B here, okay? And then B gets plugged into this is for credit spreads. And so then Kelly criterion is going to determine, based on that, how much of your total bankroll you can actually allocate. And in this case, it's basically going to amount to what is the probability that your credit spread will be profitable, and whatever percentage of the collateral that is, you have to collect more than this minus your max loss. So if we have a 60% chance of success, that means we have a 40% chance of failure. So I just have to collect more than 40% of the collateral. And in this case, I got paid exactly 40%, which means this is a coin flip. And I should put $0 of my bankroll into this trade. If the percent chance that I was going to win this was 60%, but I got paid $5, now I could put 20% of my entire bankroll on this trade. And the Kelly criterion is saying that I could place this trade again and again and again and again. And since I'm going to win it 60% of the time, and I'm going to collect 50% of the profit every time, that's a winner. But you wouldn't put 100% of your money into it because you could simply just lose. Like it's only it's a 20% chance. You know, you still have some chance that you'll lose this, but to lose it twice in a row is even less. To lose it 3 times in a row is even less. So this trade, I technically should be able to place 100 times in a row, and I should win it. I should win it 50 times and lose it 50 times. Let's look at the other trade that I placed, and let's just do this in real time. So I went ahead and did a 5 wide. You idiots. All right. I did a 5 wide. I got paid $1.16, and I bought the $10 put for 15. That means I got paid 101. So this is Mara. I got paid 101. The inside strike was 15. The outside strike was 10. Is that right? Sorry, I forgot I had put absolute value in here. All right. However, the percent chance of a winner here is 62%. Now, technically, I could work something in here too where the absolute chance of 100% loser is actually only 9%. So I would probably take like 62% and subtract the 9. I'd probably end up with like a 72% here. Anyway, the overall percent chance is probably going to be higher than this 0.62. But let's just say that anything below a $15 is a loser. Then I'm going to say that P is 0.62. And I collected like 20%. This is a $5 Y, so it's $500. I only collected about 20% of that profit. So if the Kelly criterion turns out a negative number, that means this is a horrible trade, and you should not take it because you will absolutely go broke if you make it. However, this was just for an example, and I'm just trying to have some fun with this. But I do believe that if Bitcoin is going up, Mara should go up. So, but Mara just had earnings, so premium is not as good as it could be. And if you look at their IV rank, it is terrible. So if I look at Mara, implied volatility dropped after earnings. So actually selling covered calls and puts, the premium is still pretty good. But Kelly criterion is saying that with a 0.62% chance of profit, I would have to collect more than $40, more than $38 per 100. So, $40 times 5 would be 200. I should only make this trade if I'm able to collect $2 worth of premium or more than $2. Unless the probability, if I did average it, let's say the probability of success was 70%. So this is still a loser. This would have to be well over, this would have to be like 0.85 to turn into a winner. Because I'm only collecting 20% of the collateral. So that means my percent chance of winning has to be greater than 100 minus 20. I'm a little bit nervous about this explanation. It was a lot different in my head, but let me see if I can just sum this up. Go back to MicroStrategy. You have to put up $1,000. If the percent chance of a winner is P, then the amount that you collect has to be greater than the collateral minus P times 100. So basically minus your max loss. If I got paid $4, that means my max profit is $400. My max loss is $600. That's why this is break even. But if 1,000 minus 500, because I got paid $5, now this becomes a winner. If I get paid 600, it's an even bigger winner. But if I only got paid 300, this is a big loser. If anybody's experienced with Kelly criterion and just wants to see how, is familiar with it with gambling or whatever and wants to experiment with this with their credit spreads, I'll be happy, send me a DM or whatever. I'll be happy to send it to you. And let me just drag this down here. There we go. Absolute value. All right. So I only really explained the put credit spreads. So let me just do it on Robinhood, and I'll do the call credit spreads. I'm bullish on MicroStrategy, so I would never sell a call credit spread against it. That seems like suicide. But when it pumped to $2 grand, I mean, all of the bears made money if you were bearish from $2 grand. But overall, I don't see it working out over the next couple of years. But let's just say you thought it was going to stay under 1,300 by 46 days from now. So you're going to sell the expensive one, and you're going to buy, and it can be $5 wide, it can be $10 wide, it could be however you want. Let's just go 10. Sell the more expensive one, buy the cheaper one, and Robinhood is intelligent enough to now call this a call credit spread. That's going to like your double check. If you're trying to sell a credit spread and it calls it a credit spread, they're like, okay, good, that worked. So they're saying that I could get paid $400 for this, and Robinhood is saying that this is 72% chance that this will profit, which would make my P 0.72, meaning let's just do a fit here. That means I would need to collect at least $380, I believe. No, sorry, $280 in order to make this a worthwhile trade. Am I screwing that up? 1,000 minus. All right, let's just put it into the damn calculator. MicroStrategy at 1,300. So it's 1445, 140.10. Oh, I'm sorry. 435 and 1,300 strikes. 435. Inside strike is 1,300, and we'll go to 1,310. And P was actually 0.72% chance that this is a winner. So Kelly criterion is actually calling this good. It did not like me selling this put credit spread. So apparently Kelly is a little bit more bearish than I am. Yeah, so if I was getting paid 2.8, this would go to 0. So as long as you're getting paid more than the collateral minus P times 100, that's when this becomes positive. And if you're only getting paid 2.5, this Kelly criterion says this is a no. This was pretty rough for me to wrap my head around when I first started doing it. And so I don't have the slightest idea if this made any sense. So if it didn't, let me know in the comments, and I'll try to clear things up. But this is a tool that I would use to kind of position my sizes, or maybe decide that it was a trade that I literally just did not want to take. Like if I could only get $10 and $1,000 and $1,000 collateral credit spread, you know, Kelly criterion is going to be like, no, that's seriously negative. Like, please don't do this. So, I mean, maybe this could save you the trouble of making a really bad trade. I don't know. Like the probability of success on something like this would have to be like 0.99, even more. So 0.999% chance that this is a winner. Okay, now you can make this trade. All right, I better leave it there before I put my foot in my mouth and make this even more confusing than it already is. So generally, I go over a lot of the very basic stuff, and but I know there's some spreadsheet addicts out there, some spreadsheet nerds, and I've seen a few people trading credit spreads recently. So that's how they're set up, and they can be easier on your portfolio because you can limit your risk. However, the risk is permanent. You don't have anything left. If you lose it all on that trade, it's just all gone. So that's why I prefer to own 100 shares of something, and even if there's a 50% drawdown, I've still got an asset that's worth something, and I can go out to the marketplace and sell covered calls against it and continue to make some money. It's half the money I was making a week ago, but I'm not completely wrecked. So hope that makes sense, and if it doesn't, drop some comments in the comments below, and all right, be good, y'all.